So there's a misalignment to start with where they never made money with the carried. They're making money with the fees. Doesn't work. Second part, we ask them to put their own money in it. Typically, standard terms is 1%. Well, guess what? Where does that 1% comes up from? It comes from the profits of the management fees. So they have no skin in the game whatsoever. Well, when you have, as was said before, when you have your own money in, and in Teralys, I've got my own money in, you make different choices. You don't look at things the same way. 3 weeks ago, I was making a presentation to the venture capital industry in Quebec, and I had a few slides. One of them was standard terms, the normal standard terms that you have, blah, blah, blah. Then I click, everything caught fire and burned, and said, this is a time for a reset. It's a time for a reset, or we have to realign ourselves together and to realign ourselves with the entrepreneurs and the angels, because nothing is working now. We don't have the same set of objectives in different ways. So it's a good time for me coming in with such large amount of money to invest in Canada and the world, to be able, specifically in Canada, to reset the game and align people more specifically to make great returns for entrepreneurs.
Any questions at this point?
Hi, my name's Karen Grant. I actually agree with a great deal of what was said today, but I'm involved in a startup company myself, and my question is this. We've been hearing a lot about IT companies today, and the fact that they can go to market a little bit faster, that the capital required to develop the product is not as intensive as, say, what you would have in clean tech technologies or advanced material technologies. So with the contraction of the venture capital community in Canada, and I'll be specific to Canada if I may, what is a non-IT company supposed to do that has brought in angel, has brought in early stage venture capital, and now needs to raise the next round of, say, 10 million, knowing that the total amount of money required would be, say, 55 million to go to market? Where does that money come from within a Canadian context? Angels, are they going to participate in a $10 million round? How do you create a pari passu? And even if you can build the angels, and I know that Ed raised $7 million for his company, but I believe he's revenue positive. Where do you get $10 million for a company that's still building the technology and is 2 years away from market?
So I'd love to take that.
That's a great question, Karen. If I could just add one dimension to that, and it's great that we've got Chris here. As things were collapsing in the Canadian venture capital market, the Canadian Venture Capital Association, which I paid dues to for a long time when I was a VC, was aggressively lobbying, with the help of one of our sponsors today, Deloitte, the government, and saying that we had a crisis underway here in Canada. And I was quite interested in one of the points that they made, which was that part of the crisis was that fully 40% of the venture capital that's invested here in central Canada comes from across the border. And they considered that an alarming statistic, to which I took great exception, because I thought it was one of the healthiest things I'd heard about our economy and our technology community. But maybe I could add that dimension and then turn it over to the panel. And Antoine, I think, put up his hand first.
So I'll paint a picture. I'm not a fan of pure web deals with low barriers to entry that have the illusion of being cheap and capital efficient. I'm always a little bit skeptical about what the real cost is. In my past, I built 3 semiconductor companies. Theoretically not a capital efficient industry. The truth is venture capital seeks efficiency of capital. It's about how little you can put in to reach the next stage of validation and how little you spend to get to an answer as soon as possible and correct your path. That's a fail early, fail often approach. The fundamental truth is that capital efficiency is a direct function of how ready you are to raise capital and how validated your thesis is. So let me paint a picture. When I started my first company, Skystone Systems, in the early 90s, it was a recession in those days. We spent the first 2 to 3 years basically, first 2 years I paid myself nothing, zero. We bootstrapped the company, we tried to understand the market, and we built through hard work and understanding of an opportunity between the intersection point of the data networks and fiber optics. Once we had that, we did go get angel investors in Boston, a group called Furneaux & Company, who were very networked, very active, and extremely cheap with their capital. That was the best thing that could have happened.
They were coming in with pizza for you every now and then.
Yeah, at least they fed me. But they did open incredible doors that allowed us to refine the thesis, and we were spending very little money. Your burn has a direct impact on how much equity you keep and how efficient your capital will be. By the time we went to raise our first round of venture capital, so when I started doing the tour of Kleiner, Sequoia, Seven Rosen, and the list goes on, Bessemer, Greylock, and we got term sheets from all of those. Why did we get the term sheets? Because all of a sudden they were able to call customers and find out that those crazy little Canadians north of the border had actually secured 99% of the market for optical interconnect for data switches and networking equipment without having delivered a single chip yet. So guess what? On $3 million, we delivered 3 working chips in production. The rest was a foregone conclusion. So in the end, if you run the math between the early 90s to the year 1999, a $3 million investment yielded $1.2 billion of value creation. That's capital efficient. Fast forward to 1999, where I ran a company called Philsar Semiconductor. Again, semiconductor field. Lots of capital available, lots of liquidity. People get money on PowerPoint. Well, it wasn't so bad. On $20 million of venture capital, we returned $250 million. Fast forward another 5 years, in the height of the housing bubble and the liquidity bubble in the US, we raised $60 million and we sold it for 10. Now, there are a lot of reasons for that, part of which is the misalignment between venture and the angels. Myself, as a CEO, and the entire management team painted 2 years after we had only deployed $8 million, the picture to our investors that we could exit for $120 million. And our recommendation was take it. Problem, these were billion-dollar funds who, at the end of the day, that didn't move the needle. And they would prefer to keep throwing money at it, even though we told them it did not fit the venture model. There was something already good enough in the market that fit the solution. We were excellent technology, which put in the right hands was generating good return. But notwithstanding that, the moral of the story is that it's all about capital efficiency, whether it's IT, whether it's clean tech, whether it's about solving a problem that nobody else is solving, and because you're daring to solve it and you demonstrate that you're solving it, you're able to achieve capital efficiency because you can do it on almost no capital. Your burn is low. That's the venture model.